for a few minutes
Chit
before
chat.
people join. Yeah, chit chat away.
Chit chat.
Well, let's X these things out that we're doing this, right? I would say tweet it out, but we can't say that anymore.
So yesterday the sell-off was clearly all around, Powell's comments, and I think there are four things that you have to think about when, that created the reaction yesterday. One was Powell said that the decision to cut rates was close, and I don't think anyone coming into yesterday's meeting thought it would be a close decision. I think people thought it was a slam dunk that they would cut. So his comments that it was a close decision was, I thought, disturbing to the markets. The second thing was, people thought maybe the number of cuts would go from 4 to 3, and it went from 4 to 2. So that was a little more hawkish than what I think people were expecting. The third thing is when he was asked about the inflation projections for 25 relative to the number of cuts in 25, he stumbled on that question. He had, he has this book where he has pat responses to what he knows is going to be asked, and he couldn't answer that. So what the question, I think it was Nick Timmeros asked, was, you have projected an inflation rate of 250 to 270 next year, down from 280. So roughly, 25 basis points reduction in inflation rate in 25 from 24. And yet you're talking about 50 basis points of rate cuts. Why are you cutting rates 50 basis points if inflation is not improving that much? And he really stumbled on that question. And he was flipping through his book looking for an answer, and he couldn't find it. So I think that disturbed people. So there were a number of issues in that press conference that have people a little bit concerned, I think. And we're breaking through 450 today on the 10-year, which I know some people thought would be. If you go back to, let's put it this way, go back to April, May, when this whole rally really started, it was breaking through 450 on the downside in 10-year yields that gave rise to a dramatic rally in the markets. So I think breaking through it on the upside is significant and has to be watched.
We got all kinds of stuff we can talk about. We can talk about the BOJ last night. We can talk about the Fed. We can talk about stocks. We're gonna talk stocks. You guys like to talk stocks? So we good?
Oh,
Talk
wait,
about
I might
Hims
be
and
on the wrong
Hers.
channel. We're talking about stocks today?
Stocks.
All right.
I wonder. Let's see how Russell's getting just ran over by the Sound Hound. Let's see how that's doing today.
What?
You guys want a crazy chart?
Hey, you have Bloomberg up. What, Ben? What's the peak to trough sell-off in the KRE? I think it peaked at around 70.
Hang on, let's see.
It's got to be 15%, somewhere around there.
It got to $70, I think, right?
Yeah, I think so. And it's down around 60. It's filling that gap. It's filling the the post-election gap.
Boom, 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 boom. It is. Let's see. Yeah. Can you see my screen? Not yet.
I cannot.
We'll bring it up when we get there. But yeah, it's it went basically from 70 to 61. So what's that, like 13-14%?
Yeah. Yeah, it's a decent correction. Usually when you fill
Not
the
as
gap.
good as the one from Q4 21 till Q1 23. That was the 56%er. That was a good one.
Yeah.
Were you short at all? Were you short banks then?
In 21?
End of 21 till, basically Silicon Valley?
We were definitely short Silicon Valley, that's for sure. That was a nice one for us. We also shorted First Republic, but that wasn't until we got into the new year.
All right. It's Friday.
It's not.
We have what?
Thursday.
It's Thursday. You're moving ahead.
Thursday. Sorry. I don't know. I got that Friday in my head. Thursday, post Fed Day, post BOJ Day. We got Charlie Peabody here to talk to us about banks and talk with me and about the Fed. And we got David Maris talking everything that is healthcare and always HIMSS, our favorite controversial stock on this program. This is Wall Street Beats. My name is Ben Brey. So let's get it going. Let's start, Charlie. Let's talk about the Fed yesterday. What do you think? What do you think? What do you think of what Powell said? Why do you think the market got unnerved like that? And where are we going from here? And what does it mean for banks?
Yeah, so I think there are 3 or 4 things that I would highlight from the press conference that upset the market. The first was when Powell said that the decision to cut rates was a close decision. I thought everyone expected that to be a slam dunk decision. So that I think was disturbing that he said it was a close decision. The second thing was, when they cut, they reduced in the dot plot the number of cuts to 2 down from 4. I think people were expecting maybe 4 down to 3, but not down to 2. So that was a little more hawkish than expected. And then the third thing is when he fumbled a question, I think it was from Nick Timmeros of the Journal, when he said, you're projecting inflation to drop from 2.8 down to 2.5, 2.7, so maybe down 25 basis points of inflation. But you're talking about 2 rate cuts of 50 basis points. Why more rate cuts when inflation's not making a lot of progress? He didn't have a good answer to that, and he was fumbling through his book trying to find a pat comment, and he couldn't do it. So I think people were a little bit disturbed by that. And then the final thing, the fourth thing that I think really upset people was he was asked, is it possible that you could raise rates in 25? And he, honestly answered, it's a possibility. So it's, all of a sudden the idea of rate hikes was put into the equation. So I think those 4 things were what really upset the market and got, the selling going. Now, listen, from a bank investor point of view, I think this is a buy the dip scenario. The positioning had gotten way offside. And I had pointed out, I think last week or the week before, that the weekly RSI for the Consumer Finance Index, for the XBD index, KRE, had hit multi-decade highs. And so we knew that there was going to be some sort of overbought condition that had to be worked off. The KRE is, I think, filling that gap, that post-election gap down around 60. If I haven't looked at the screen this morning, but
yeah, I'm looking at it right now. Here, let's pull it up, Jen. I have that pulled up for us. If you look, this is This is the KRE going back. This is the drawdown on the bottom. This is the implied volatility, and this is the momentum indicator. You can see the momentum starting to roll some, but look, that was a monster move. We got, beginning of October, this thing is 55, moved a little too fast, and we're kind of at that trend line now. I mean, if you look at this, it's like 61. Maybe it kind of gets into this level, 58 or something. But Charlie, when we think about which ones of these, because the KRE is obviously an index that is the regional banking index, which ones you like specifically in there if you were to be a buyer here?
Yeah, I like MTB right here. I mean, it could trade down to, the high 170s. We're at, 85, 86 this morning, I believe, somewhere around there. But MTB, which is M&T Bank, based up in Buffalo, New York, very conservative balance sheet, very liquid balance sheet, a lot of excess capital. They're buying back stock. 3 to 5% of their stock will be bought back. They've got a conservative management team, great chairman and Renee Jones. They have good earnings momentum. I think you'll see estimates raised going into the new year for the fourth quarter and for 25. So that was one that I would certainly buy here on any weakness.
Let's look at this chart real quick as we're at it. Oh, I'm sorry, I got to move that. Is you see, this is a pretty good looking chart, to be honest. This is moved up. It doesn't, it's not too volatile. It has like this move. We gave it back some. And so, maybe 180 was where you kind of really dig in there, but it's given back most of the post-Trump move, to be honest. What is this? This is about November 5th. Yeah, you can see it, the Trump pop right there. So we're right back to where we were on that. And, that's a good 16% drawdown. Where can this stock go, though, Charlie? So we're buying it here in the 180s.
I think
the deregulation thesis to play out, as I think we expect. Where can this bank be in a year or 2 years? Frame it from that, not just okay, it's trade today.
No, I think 240, 260 is a very reasonable price target at some point next year. I may be jumping ahead of you, Ben, but you mentioned the deregulation. So yesterday, Portales Partners hosted a call, as Ben knows, with French Hill, and he's the chairman of the House Banking Committee. We asked him what his 3 priorities were, and he started off with deregulation as number 1. It was interesting. He is on board with the Bitcoin or stablecoin, I should say.
Stablecoin is what he said. He said he was neutral on Bitcoin, but definitely that the U.S. is going to have a federally backed stablecoin.
Yeah, that's fair. And I do think that we've taken out the deregulation premium that had been in there, as of November 25th, and we've taken that back out. So, and I think it's a real multi-year theme that's going to play out in banks' favor. So I think this buy the dip for some of these regionals like M&T are worth doing. I don't know, Ben, if you want to talk a little bit about some of the areas that are going to see some earnings estimate adjustments going into the new year, but Wells Fargo, I'm at $1.42. The street's at $1.34 for the fourth quarter. So I think there's some, adjustments there. I'm above the street with JP Morgan as well. Citigroup, I think, is going to beat the street. So I do think that as we move towards, January 1st, 3rd, 5th of the new year, you're going to see a lot of sell-side analysts adjusting upwards their earnings estimates for these banks.
Yeah, okay. So, and let's talk back real quick about the Fed. So everyone was like, oh, it's going to be a hawkish cut. And I don't understand, we got a hawkish cut, and then it was people seem surprised. And I just kind of think, to what you said, that there is some, okay, they took a couple cuts off and there was some uncertainty. But I think also what happened yesterday was just too much leverage, too much, just similar to what happened in July and June. If you guys remember on this program, I had pretty much pounded the table that there was just all this vol selling and dispersion trading that had built up, and then it kind of unwound and it crescendoed in a huge VIX spike on August 5th, and Charlie had been bearish. And some of that's just mechanical, right? We look and see the silliness of this market in some areas. But then again, the Dow was down 12 days in a row this month. Okay, banks have been down almost the entire month. The IWM's been down. The more losers than winners for 11 or 12 days in a row. So there is a chance that yesterday was a bit of a capitulation in that sense, even though the Mag 7 and the Soundhound and the Fart Coin and all this stuff has gone bananas. There has been some weakness under the hood, right, Charlie?
Oh, no doubt about it. I agree with you with your analogy to that, 3-day sell-off in August. I think that was, that poor positioning, and I think we had the same setup coming into yesterday's FOMC meeting. So I do think it's a buy the dip, and I think there will be a rally into the new year at some point.
And let me put my screen up one more time. I want to show this. Charlie and I had talked about this, and then we'll move to David after that. You can see this is the 3-month in yellow versus the 10-year rates going back to 1970. So this is the entire fiat range, and this is the term spread, right? And so what you see is we're just popping uninverted again, right? And so you kind of rolling over right here. So when you see this, the comparable periods of this are not good. It's the fall of 19 when you see this. It's let's call it Q207. It's the beginning of 2001, and then this is the period Charlie and I talked about, which is maybe the most comparable. Is this 73, 74? Is maybe we're in a period where okay, we had this inflationary bust like the early 70s, and then we had to digest it, and then we had a bit of a deflationary shock, and then on the other side, we had the late 70s, and Charlie and I have gone back and forth a little bit recently about basically what's going to happen with rates. And my personal view is that short rates are going to keep going down, and that long rates may just stay where they are. And if you see on this chart, that's what happened in that 70 period, right? Short rates came down, the long end actually kind of went up, right, or flat to up. And you saw that a little bit in the 90s as well, where they start cutting. Then the long end kind of followed through a little bit, but you had this period as well. And so I think that the rest of the world is sinking right now, sinking like a ship, if you will. And they're gonna bring us down because the yields are just so much higher than the global rate. And so it's part of what's going on with the Fed has to be thought about in the global context as well, because the dollar is absolutely ripping. We're at a 108 DXY, and the euro's got a 103 handle on it. And so I don't know, Charlie, what's your thoughts on that 73, 74 analogy?
Well, there's a good part and there's a bad part to it. And if you take a multi-year secular view, the good part is if we can get the short end down to 3% and the long end stays around 5%, that's a really good spread for the banking industry. And so we've just gone through a decade where NII, which is top line revenues or spread income, was not very constructive for banking. It wasn't growing. But if we can get back to a positive yield curve, a steeper yield curve, that's an environment for banks to mint money on net interest income. The old adage in banking used to be 3-6-3. I borrow at 3. I pay my depositors at 3%. I lend out at 6%, and I'm on the golf course by 3 p.m. So that 3-6-3 was the old adage in banking. But that 3% deposit cost, 6% lending rate was a great spread for banking.
Yeah.
And so that's the positive. The negative of 73, 75 was the REIT debacle. And that is, something I still think the community banking system faces is a commercial real estate problem. And, they have an exposure to commercial real estate. I followed the Texas banks in the early 80s. And by 83, 84, the Texas banks were starting to experience some commercial real estate problems because of the boom bust cycle in energy. There was a reprieve in 75, 76, where people thought maybe the worst was over. And by 87, 88, every single Texas bank except Cullen/Frost was failing. And what the lesson there was that commercial real estate has a very long tail in terms of discovering the true value underlying the property. And right now, there's a little more optimism around commercial real estate or less pessimism. I'm not sure which way you would describe it. But I don't think the commercial real estate problems have completely gone through the system. And I think there's going to be a fallout sometime in the 25, 26 area. So those would be the analogies to what you were just talking about in 73, 75, a better spread environment, but you have some credit issues on CRE.
Yeah, I'm with you. I think that things unwind, and there's a lot of badly marked assets out there. And the reality is if you just, I guess let me put it this way. The one thing that's Sant talked about, and that I have charts, but I don't have them with me right now, is the amount of T-bills that have gone into the collateral system is enormous. And I have a product that's launching that does derivatives, and we use T-bills. So we own T-bills, and then we use a bunch of leverage because we use the T-bills as collateral, but then we earn the 4%. And I'm a minor player. There's major players who get 20 to 50 times leverage on the T-bills. And so that has actually perversely created all this liquidity in the market. And so I think if you make the less T-bills and you make them less attractive, well, all the guys who termed out their money, the people who are rich that termed out their 30-year, refied their 30-year mortgage, or the Apples and all the whole list of the S&P 100 that has a ton of cash and is sitting there just collecting free money from the government, make them take some risk, make them go out the curve, make them take some credit risk and these things. So I think perversely cutting rates is actually the worst thing for the market, whereas in the past the higher rates. And this is, we talked about this on a show a while ago, Charlie, but like I just don't think the market fully understands, like and the RRP is almost gone now, right? That was a huge source of liquidity as well.
Below 200 billion, yeah. I mean, it's non-existent practically.
Yeah.
Ben, one other thing I was just going to mention, and keep me honest because I don't have my screen up. I haven't looked at it this morning, but I think the home builders are still selling off this morning, aren't they? I mean, if you look at Lennar or DHI or LEN.
Well, what's the ETF? XHB?
XHB, yeah, is the home builder ETF.
Yeah, I would say it's safe to say they're still selling off. Yes, they're at the lows of yesterday.
Yeah. So, yesterday we talked about Lennar disappointing. They certainly did last night after the close. I think that stock's down 4% or so this morning. But yeah, I mean, affordability, in residential real estate is still a huge problem. And, you've got, I think, 9.5 months of supply of new homes on the market. So I expect home builders to continue to have to offer incentives or mortgage buy downs to move product. And that's not good for gross margins.
No. All right. Well, let's switch trains here to David Maris. What do you want to start with, buddy?
Well, we can start with there's some news out on Vertex. They have a drug data that came out, and they said, "Oh, look, this is great." It didn't outperform the placebo, so the last I checked, the stock was down 12%. So hard to claim victory when your stock's down 12%, and the folks at Stat News and the rest are making fun of your results. Probably not a good look for Vertex. But the whole XBI has been killed this last year. It's actually down for the last 3 years. So people in biotech, healthcare investors are really, no one really wants to own healthcare. You don't know what the new administration is going to do. Are they friends of pharma, which they sound like recently, but they're definitely not friends of PBMs and insurers. The sentiment around insurers couldn't be worse. So, healthcare has just been sucking wind lately. I can't be too constructive on it. I do kind of bottoms up for stock by stock, but let's start with HIMSS since it's a hot topic. You and I spoke about it a couple days ago. I had told you, I actually asked your advice. I said, I had always said that it was worth $30 with or without this, without the GLP-1s. Should I play it for the December 21st? The FDA is going to come out, or a court's going to come out and say whether or not they should, the Lilly drug's still in shortage or not. And if it's not, well, the stock's going to pop up again. And there's a good reason to think that the administration or the FDA would kind of punt this for the new administration to decide on. But it could go either way. And your advice was, look, you've made a bunch of money on this, percentage-wise. It's a great call. Just get out of the way. So I did. And I'm glad I did, because today it's down 10%. Yesterday it was down, I think, 7%. I still think that this is a $30 stock with or without the GLP-1s. But let's get past this data point. And I do think that I don't want to say always buy it because this lives for a long time, but I'm always very interested in it below $20 because I think
pull up the chart. Yeah, Jen, see if you can pull up the chart for us. Keep going. Sorry.
Yeah, I was just going to say, I think you can, it's if it's worth 30, if I think it's worth 30 and I can get it for 20, that's a great margin of safety for me, at least. And so even if this stuff changes, I'm not so worried. There was good news that came out 2 days ago that really got overlooked, which is the administration did allow for the next couple of years telemedicine to continue. So, some Medicare wouldn't allow it if these rules were allowed to expire. That happened during the pandemic. During the pandemic, they said, "Oh, let's let's make it so that people can use telemedicine, and that's great for HIMSS.
Yeah, so you look at that chart, and to be fair, what we were talking about is just when you think about a risk reward, I mean, it's not always about being right. It's about, we don't know the future, right? And so we're like saying, hey, 50-50 and it's up or down, and like it's just not worth it, because even if I'm right and I feel I'm right, who cares? It's just not it's all about making good bets. And David's been very right on this stock. It's been very good, at the expense of our colleague Russell, who's been short and getting run over. This stock is a great, like, these guys sell products people want and they're very good at it, but it's very volatile, right? So, I mean, this is a great trading stock, wouldn't you say? Like, I mean, it's holding, you got to hold your nose, but like, there's been a lot of spots where you can buy, trim some, buy some.
Yeah, well, and to me, what makes it great is I believe that there's a storehouse of value of, you have this subscription model for a bunch of different drugs. So if you have that, that's a stickiness. You can get rid of the GLP-1s, but you still have all the erectile dysfunction, the anxiety drugs, the dermatology drugs, all the women's health drugs. That's going to stay, and that's been growing like 30%, year over year. So I feel good about it if I held it, and that's what makes it a great trading stock. Is that it's not like a biotech where a drug fails, a one product company fails, and you're down to zero or you're down to cash. So I like it. I just I did what you suggested and brought it down by 95%. So I still own a couple of shares that I'm watching, but that's
I just pulled up the CVS. Let's talk about those PBMs and CVS. I was looking at the CDS on CVS. I know that's a mouthful, but the credit default swap spreads on CVS have really blown out from 55 basis points to 82, and the stock's down 30%. I mean, what do you think? Like, do you think the PBMs are just the scapegoat to try and not go after pharma, basically?
Yeah, I think that's right now. That's the sentiment, but it's still a wild card. I think that Trump's going to go after pharma. I think that the easy win to get his nominee into HHS and the others confirmed is, hey, pharma, we're going to be okay. A couple different news organizations came out and said, amazingly, pharma is not fighting against RFK, and his meetings so far with senators have been very positive. So I again say that he's going to get confirmed. I think then kind of all bets are off in the second or third year, but the PBMs definitely have a target, insurance companies, and you kind of see it with UNH and Cigna down again today. They rallied a bit off of their big drop, but the reality is that to me, this is just, why would you want to be in there? I mean, yes, they do have great, not CVS. CVS is sucking wind on all three of their businesses. So to me, the natural inclination is for them to split up, even though it doesn't solve any of the problems. If you have a couple bad assets, you might as well just focus on one of them and try to tell people that you're gonna fix that one. Saying that you're gonna fix three that you've mismanaged, probably not a good idea.
Yeah, I mean, that's a bad chart. Charlie, what do you think about that chart? Is that a chart you'd be a buyer of, or is that just a permanent sell?
Not something I want to step up to. And I'm
that expanding drawdown. This is like the peak was in the end of 21, and it's just getting larger. I have a feeling that this is going to go into the 80s, 70s, or more. These boys look like they're troubled.
Yeah. So I was in a doctor's office the other day, and this is emblematic of what's going on across the country. Had to get an orthopedic boot, so something for a broken foot for a loved one, and the person came in and said, "Listen, your insurance is going to be $600 cash, $500 cash, or you can go on Amazon and get the same exact thing for $45." And we've had patients get it the same day. You might have to go the next day, but it's a broken foot. You're not, as long as you keep it elevated, nothing's bad's gonna happen. And I said, well, that's kind of crazy. And they're like, yeah, it absolutely is. And I asked, are you seeing an uptick in the anger of patients and the confusion of patients? And not just since the murder of the executive, the horrible murder, but over the last couple of years. And he was like, absolutely. because what's happened is to get everyone on these exchanges, they forced everyone on, and now they're slowly taking away benefits and increasing the deductibles. And everyone feels that, everyone knows it. And so I think when you think of 2025 and you think of, well, what's going to be the target? I think the targets are going to be those out-of-pocket areas that are most susceptible for patients being angry, and that's PBMs and that's insurance companies.
Yeah, I mean, people are pissed off, and it's crazy to think about. Let's go back to the GFC, and then Obama comes in and he wants to have this healthcare plan. Clearly, he didn't get the plan he wanted. United Healthcare is up like 10 times since then. You know what I mean? And like the cost of my insurance has gone literally exponential relative to that period of time. And you know, I'm not like I'm way over my skis here, but I just know that no one like is very happy about the situation. I think is fair.
Yeah, and that's the part, and people aren't stupid, right? That's people go, okay, every year, in fact, very recently, they put out that more people have insurance than have ever had it before. So a higher percentage of people. Well, that's because you're forcing them. So that's one. And it's like other countries that say they have national health care. And we often compare ourselves and say, oh, we don't have national health care. We have it for elderly and poor people, but we don't have national health care. But what you don't know are the benefits that those other countries have, or the lack of benefits. And so if you force everyone onto a plan and you say, okay, now we have universal care, but people are going broke for it, is it really universal care, or how caring is it? So I think that the zeitgeist right now is those are targets. I think the administration knows that. I think that they are actually targets, and something's got to give. So I'm not chasing these insurers or PBMs down. Are they cash machines? A couple of them are. Yeah, they certainly are. But I'm not. I like being a value investor, but I don't want to go against this sentiment. And let's see if when the sentiment changes, I'll buy it back and maybe at a higher price, but I won't have the risk of some buzzsaw killing me. I'd much rather own. I think I told you before, I'd rather own a Haleon. Haleon's come down with the market recently, and kind of during the zombie apocalypse, people are going to still buy Tums. And so it's a great cash flow business that's paying down debt. The same was true with Teva. Much more stretched balance sheet. But I like those things that are kind of simple, that are going to be day in and day out. People are going to get generic drugs. The environment for generics isn't getting worse. It did a few years ago. It's not getting worse. Haleon, the environment for Tums isn't getting worse. Sensodyne toothpaste. Now, maybe people can't afford those things and they go for store brands, but again, going into 2025, I really like Haleon. I still like Teva. I like Z-Lab and Lifetime Fitness.
Hey,
okay.
Ben,
You want to take a look? Look at this, you guys. The IWM is back at yesterday's lows. Wow. Just fading.
So if you go to if you go to the XBI as well.
Let's see that. All right, XBI.
Let me just say something about the IWM and my input from the banking seat. We just had a banking conference here in December, and a couple of the regional banks, we're talking about credit quality and how solid credit quality has been. But the question always comes up: where do you see the cracks? Small businesses is where they're seeing some stresses in their portfolio, and the reason for that is they tend to be more floating rate borrowers rather than fixed income. So a lot of corporate America termed out their debt when we had the pandemic and got zero rates, and but those that are relying on floating rate debt, they also mentioned higher labor costs, and they mentioned higher insurance costs. So if the IWM is exhibitive of small businesses, there is clearly some stress developing in bank portfolios in those small business portfolios.
Yeah, I mean, look at them. Look at this. How stupid the IWM is. And go back to July when we were talking about it. That it's crazy. Look at this. We had that move. We had the CPI July 10th. It comes in weak. And then we get the huge rally, short cover, and then boom, just gone. Trump wins, blah, 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 and now we're gone. It's just like the exact same thing. It's hilarious. And this was probably the August 5th low, and there you go. So there's some similarities actually to that August 5th. You look at this, you look at the IWM, it's like, this is the pod shops getting blown out. Somebody's getting blown out or enthusiastic, and now we're coming back. What did you won the XBI, David?
Yeah, the XBI is the biotech index, and
Doesn't
it's
look
showing,
good.
yeah, it's showing the same exact thing, that there was trying to be a bounce earlier today, and
Oof.
then everyone's like, you know what? I'm going home. This is not, it's not. So, unfortunately, I know a lot of healthcare fund managers, and I don't want to rain on their parade. It's just, are you going to jump into healthcare at this point? Now, I think there are some really good stories that have catalysts at the end of this year, early, next year. That's the kind of thing you have to be an actual stock picker. You can't just be like, okay, well, I'm going to own a lot of these.
What a terrible product! Look at this thing. We go back to Christmas 2017. You're flat since then.
And think of all the innovation that happened. And so what happens is people are like, oh, but you have to own innovation. And you do. You should. Like, I want to own the next cure for Alzheimer's and everything. But a lot of those companies are also junky companies. So you go, okay, so we fund some good ones and we fund some bad ones. I do want to say, though, there was a great chat the other day on X that Martin Scarelli, you might remember him as Pharma Bro.
Yes.
Yeah. So 2 days ago, he hosted a thing, and it was a big chat about Bitcoin and some stocks. But if you just listen to the Bitcoin part of it, it's so hilarious because he says, look, I'm short Bitcoin. I just don't believe in it. And someone said, well, do you consider it, and I don't like the phrase, but I won't use the curse word, but do you consider it a junk coin like some of these others? And he goes, yeah, absolutely. And the people who are pro Bitcoin, you don't want to get in their way. They're like, you don't understand the algorithm. You don't understand the crypto. You don't understand that it's a storehouse of value. And he goes, well, why would the US want to encourage a different reserve currency? Because then it's just selling its own currency. And he made a very good argument. But you hear, what was most interesting to me is that the fervor that you hear is the same exact thing you heard about, smoking guerrilla artwork, non-fungible tokens and things like that. Just a couple years ago, it's the same. And if you look at what happened yesterday in the sell-off, Bitcoin dropped. So the idea that it's a safety place, it's where people, a storehouse of value. It tells you.
Well, look. I've talked about this at length on this program. That Bitcoin is not gold. Bitcoin is a network that's unique. Visitors are flat since 2018. Go to blockchain.com. You can see it. The hash rate's gone up, the complexity's gone up, but the truth is, in 2017-18, this was exciting. It was a secular growing thing. 21, some of that. Now it's just Wall Street's got its hands on it. They want to have a fee generating engine. They're making money. And this is just a money grab. And I'm really happy for everyone who made money. But let's just call a spade a spade. There's no one using this for what the dream was. Now it's just everyone's just excited to making money. And that's great. It's a place for the US government to stash a bunch of excess deficits. Again, I come back to I read this book a long time ago by Peter Warburton called Debt and Delusion. And he talked about in the 70s, and Charlie, you can talk about the banks, we had this inflation and the government wanted to keep running deficits, but people wanted nothing to do with the inflation, okay? And so they had to figure out, where can we store all this money? Well, you know what it did? The bond market. That's where all the money, all those excess deficits sit, and you just need more buckets to put stuff in if you're going to keep spending. I don't know if you guys saw the spending bill yesterday. That was absolutely ridiculous. I don't know where these Doge guys are at. Basically, this is just the stable coin that Charlie and I talked to French Hill yesterday, just another place to stuff deficits. I mean, I think that's what it really is. It's a repository of that. But when liquidity gets sucked out, Bitcoin is levered NASDAQ. There's no difference. Gold dominates Bitcoin historically in sell-offs, completely dominates. It's not even close. So I'm with you completely. One last thing here, Charlie. I know we were chatting last night, buddy. You're trying to be a hero here on the Euro. Hero on the Euro. See what I did there? Tell me why you're buying the Euro, this pathetic continent that's had just a disaster 15 years of mismanaged economies and should really be an amazing place. What are you doing here, buddy?
Well, first of all, let me put context to that comment you just made. So I said on the next gap down, so we get to parity. That's where I'm interested. So the rationale is, the problems overseas are eventually going to wash up on our shores. And the currency differentiation is getting to be somewhat extreme. And, if you're going to play through your 73-75 analogy, somewhere in there, we're going to be looking at a recession. And that's what's being discounted in France right now, but not here in the United States. So I would say that our currency has some, I don't know if you want to call it deflationary catch up with the euro, but in that scenario where all of a sudden their problems wash up on our shores, we're thinking of a 73-75 scenario of a potential recession. I think the dollar starts to weaken during that period. So that was
Charlie, I have a question for you.
Sure. Go ahead, David. Sorry.
What is the chance that inflation is higher next year at this time than where it is today? What percentage probability do you put that on?
What's the baseline? So what are we saying the current level is?
2.8 right now. 2.8, let's say. And that's what they used in their SEP, the summary of economic projections yesterday at the FOMC. So the possibility of
I'm for sure lower. I'm for sure lower.
If you have a recession and housing, collapses again, deflates, then I'm in Ben's camp. But for the moment, I think that the odds are higher inflation. We have this is where it gets tricky because Trump is different, but historically we've tried to inflate our way out of big deficits, and I would bet on that. I mean, I'm buying things that hurt when you drop them on your foot. Hard assets. So if I drop a barrel of oil on my foot, that's going to hurt. And I know that's a contrarian play right now because oil is not doing well. But that, I think, the bias of government is to reinflate your way out of deficit situations. So
speaking of oil and gas, Bob Morris this morning said, listen, he wanted to jump on. He's in the middle of something he can't, but CNQ is down with the market and that it now has a 6% yield. He'd be buying that because it's just kind of crazy down here at this price. That he has been buying it. I shouldn't say he recommends people buy it, but he would be buying it. He's buying it. So I wanted to pass that along because that goes with what you're saying.
Hey, David, this is way out of my comfort zone and it may not be a fair question, but there's been some news on the bird flu. Are the vaccine stocks worth looking at, or?
I hate to say that because they might be worth it for just the sentiment wise. I don't think like a Moderna has a great ongoing business when you used to sell billions and billions, $20 billion worth of vaccine, and now you sell 3, and guess what? It's going down. And I also think that there is a pushback on, yesterday there was a lot of news about RSV going around, and so I mentioned to someone, I said, be careful, that might just be pharma trying to sell you RSV vaccines. I said that jokingly, but the other person was, you're 100% right. Yeah. And so the skepticism about optional vaccines, whether, that's a real thing. Now the bird flu, I mean, this is the first serious case. The person might not make it. And when that happens, all of a sudden it's a stock reaction. So like, from a fundamental standpoint, I don't think so. But from hey, could these stocks run because they're so shorted and they're so disliked? Absolutely.
I mean, okay.
By the way, that would be Sanofi, Pfizer, Moderna, Novavax, probably those 4 as a basket. If you wanted to play that for the next 2-3 weeks as this goes on. But yeah, I mean, that is a big fear, is that this spreads.
Yeah,
All right, and I want to come back to this chart real quick. Jen, can you put this up? Just so I didn't get a chance to tell Charlie. So just remember, in the 70s and 80s, we're using the Bundesbank, and we're using what the Deutschmark was. We could be at a 60 to 70 cent euro. I just want to make sure people understand. Like, I think the euro's going right here, 85 cents. 85 cents. And it's going to blow people away. And that's what they need. If the Europe wants to be competitive, they need a 25 to 30% reduction in their currency to be competitive. And the question will be, what does China do? Will China let that? Will China let that happen or not? And so, but I think that there could be a trade. Charlie could be like, in the short term. But this is looking like it's going to the Goblin Town, if you will. Anyway,
sounds good.
All right,
I'm
guys.
Not gonna argue.
The reality is that this market is very interesting. There's a lot to do. We're looking into next year. Come join us and hear what guys have to say. There's been we reflect back on the year. There's been a lot of good ideas. It's just fun to think about July and August. Now we got this again. And, if you got used to hanging out with these guys like I did, there's been a really good flow of information and a lot of good ideas. And, so come check us out on Wall Street Beats. I'm Benjamin Brey. That's David Maris and Charlie Peabody. Thank you, guys.
Thanks, Ben.
Yeah, buddy.